Things just seem to be getting worse for America's troubled retailers. 1 in 10 retail companies is at risk of closure this winter as we enter another economic downturn and consumers roll back their spending on non-essential goods. New data shows that the number of businesses at potential risk of defaulting their debts, going bankrupt, or closing shop for good continues to grow. In fact, earlier this year, Toys R Us CEO warned that a flood of bankruptcies would hit the retail sector during 2022's final quarter as the compounding effects of inflation, supply chain shortages, transportation disruptions, and tighter credit conditions kept on weighing on the balance sheets of distressed companies. We are in the worst supply chain crisis that any of us can remember. And there is no sign of the problems easing before the end of the year. For retailers, the problems could be particularly severe as they prepare for autumn and peak trading in the months building up to the holiday season, added Brightpearl CEO Derek O'Carroll. We're still in the relatively early stages of this crisis, with the impact of global events just starting to really hit home. In a new report on vulnerable retailers, Credit & Tell cited bloated inventory levels as a major pressure on margins and profits. The imbalance led major companies, including Walmart and Target, to cancel billions in orders recently. Potentially, the biggest stumbling block will be the consumer. Albert First, Chief Operating Officer of Credit & Tell, highlighted in a recent interview. With store closures still mounting while foot traffic declines, a financial disaster is looming for U.S. retailers in the near term, and in today's video, we have listed some of America's most iconic brands that are in danger during the make or break holiday season. Before moving on, please support us with a thumbs up and subscribe to our channel so you don't miss our upcoming lists. Without further ado, here are 15 retailers that are at risk of bankruptcy during the coming deep, dark winter. 1. Bed Bath & Beyond. Over the past couple of years, the retailer has been on a roller coaster ride. When lockdowns began, sales shot up. But a few months after that, supply chain issues and a steep drop in consumer spending brought the company's profits to the ground, and from that point on, conditions only worsened for Bed Bath & Beyond. During the summer, the company's CEO resigned after a very disappointing quarterly earnings report. In August alone, its stock shares dropped by over 40%, and according to the Wall Street Journal, the retail chain is at huge risk of going bankrupt as it starts refinancing its massive $1.7 billion debt load at a time inflationary pressures continue to dent shoppers' purchasing power. The household brand already announced plans to close over 150 stores and lay off staff to cut expenses before the end of the year. If the company will be able to make it through this holiday season or not remains yet to be seen. But industry analysts are calling its current situation the year's biggest retail train wreck. 2. Tuesday Morning. Tuesday Morning's among the long list of retailers that already have filed for bankruptcy and are now at risk of going entirely out of business. A dramatic revenue decline in 2020 led the retailer to run out of cash and seek protection as its debt burden increased by $10 million. In the company's most recent period, it reported a 7% drop in sales, and it projected an adjusted loss of up to $29 million for its current fiscal year. S&P Global Market Intelligence has listed Tuesday Morning as one of the most vulnerable retail companies right now. This holiday season is gonna be a make-or-break moment for the already bankrupt retailer that has closed 200 stores since January 2021. But if projections turn out to be right, this means the near-term future of the company is gonna be extremely gloomy. 3. The RealReal. Before the pandemic, the outlook seemed bright for the RealReal. From 2018 to March 2020, the company's revenue grew by 40%. But Over the past 12 months, it's seen losses mounting up to $100 million. In face of some poor full-year numbers, the company's stock is trading near its all-time low. It's lost nearly 70% from its initial public offering price, significantly underperforming the market quarter after quarter. And to make things even worse, just a few months ago, founder Julie Wainwright stepped down abruptly from the CEO role after 11 years. Today, the apparel retailer's probability of bankruptcy is at 75%, according to an analysis released by MacroAxis. 4. Wayfair. The home goods retailer is a consumer favorite, but shoppers' preference alone may not be enough to save Wayfair. The company has been posting a net loss for every year it has ever reported publicly, going back to 2011. Even when demand for home furnishings went up, Wayfair's revenues were still timid, given that it kept operating on a very thin profit margin. For the entire 2021, Wayfair was in the red, but things became significantly worse this July when the company was the only e-commerce retailer to lose revenue among the top in the sector, according to global data. There is a fundamental weakness in Wayfair's business model. It needs considerably larger volumes and many more regular customers to attain profitability, Global Data Managing Director Neil Saunders explained. Now that demand is normalizing, Wayfair is back to making eye-watering losses, he added. Last month, the retailer announced a 10% cut to its corporate staff to reduce costs. It also reported that its operating loss widened to $94 million, while its net loss reached $131 million. Meanwhile, active customers fell by more than 12% in the last quarter, which means that only a miracle can turn things around for the company this quarter. 5. Digital brands. Less than a year after going public, the Digital Brands Group is warning that it could go bankrupt by year's end due to a shortage of liquidity. 2022 was a year of extensive losses for the developer. In February, it was sued by creditors over late payments. One of them demanded the retailer put its expansion plans on hold until it was paid for goods shipped years ago in 2019 and 2020. In the second quarter, the company's operating loss was at $10.7 million. It also owes $6 million to a secured lender, which matures in December, and creditors are on the edge of their seats right now due to the high risk of default. Spending in the luxury sector has been on a steady decline, and with inflation still biting, the landscape doesn't look good for the group. 6. Rite Aid. With over 2,500 stores in 19 states, the famous U.S. pharmacy chain is in huge trouble. Rite Aid managed to lose more than $600 million during the pandemic, while its pharmacy rivals boomed. Earlier this year, Deutsche Bank analyst George Hill issued a damning downgrade of the struggling retailer, saying it could go completely out of business within a few months. In the last week of September, its stocks plunged by 28% in a single day, after earnings reports were much weaker than expected. One major aggravator is the fact that the company has a bloated $3.2 billion in debt after years of aggressive expansion that hasn't panned out. From those, it holds $1.5 billion in outstanding high-risk debt and is in danger of default as maturities come due next month. As the Wall Street analyst argued, Rite Aid has become unable to generate enough cash to stay viable, and its demise is only a matter of time. 7. Victoria's Secret. The lingerie giant is currently closing over 1,000 stores all over the nation. For years, it has been suffering from lackluster sales and slower foot traffic, and it edged near bankruptcy in 2020 during the pandemic shutdowns. But the problem with the retailer goes far deeper than that. The company is losing the support of even its most faithful customers due to controversial statements and social media scandals in recent years. To put it bluntly, Victoria's Secret now has a bad reputation, and its survival is being threatened by the rise of more inclusive and more comfortable brands. 8. 99 cents only. Retail Dive reports that the company recently made a deal with creditors and its private equity owners to trade debt for equity. The announcement caused S&P to downgrade the retailer's credit rating to CC, meaning that it is at high risk of default and ultimately of going bankrupt. The truth is that the near-term future of the discount retailer remains uncertain as supply chain challenges and higher inflation eat a larger share of its profit margins, and shortages continue to dampen sales. 9. Best Buy. Best Buy just joined the list of retailers warning about slower consumer spending this quarter. It cited weaker demand for electronics and persistent inflation as the main causes of its latest financial troubles. The company's shares initially fell more than 10% following the announcement of lower profits. The company is set to face a dark winter as it fails to keep up with larger competitors. 10. Toys R Us. The company first filed for bankruptcy in 2017 when it was drowning in $7.9 billion worth of debt. Since then, Toys R Us has been liquidated, resurrected, liquidated again, and resurrected again. But in August, lenders asked during a court filing how many more defeats the company could take. Operating at an average loss of $1.9 million a month, the retailer has already lost $21.8 million while it holds a total debt of $5 billion. 11. The Children's Place. According to Forbes, losses keep piling up for the nation's largest children's apparel retailer. After publishing its second quarter fiscal report, its shares collapsed 11% the very next day following the company's dismal performance. Both the top and bottom lines not only missed the Zacks consensus estimate, but also declined year over year, investors noted, adding that cautious consumer behavior amid the soaring inflation, increased promotional activity from key competitors, and supply chain issues adversely impacted the company's results. Although it managed to negotiate about $13 million of its rent debt, that may not help the company avoid filing for bankruptcy this winter, they highlighted. The Children's Place is now on track to close more than 300 stores, and many more closings could soon be announced. 12. The luxury retailer, which operates the Michael Kors, Jimmy Choo, and Versace brands, is currently closing 170 stores all across the country. And this year's holidays may not give Capri much reason to celebrate. Executives are bracing for a 70% revenue drop. Supply chain challenges and changing consumer trends have turned things upside down for the company in the past year. And the fact that it has almost $150 million in distressed debt also doesn't help. 13. Tailored Brands. The owner of Men's Warehouse and Jose Bank was one of the hardest hit by the pandemic store closures and the rise of the work-from-home era. After closing hundreds of stores and filing for Chapter 11, the company emerged from bankruptcy in December. Months later, the company was back in court with its attorneys explaining why it needed another emergency infusion of cash or conditions could turn sour again. According to court testimony and documents, the company almost immediately ran into liquidity shortfalls after emerging and was staring down another bankruptcy. The consensus in the industry now is that it will likely face liquidation and go out of business over the next 2 quarters. 14. Chuck E. Cheese. The beloved restaurant chain may have its days counted. The Wall Street Journal reported that its parent company, CEC Entertainment, recently asked lenders for a $200 million loan to keep the business open. But with nearly $1 billion in debt and a 21% drop in sales, creditors are still debating whether or not the company is worth saving. Executives argue that the restaurant chain isn't keeping up with consumers' behavioral changes, and soon it'll become too boring for today's kids. 15. Brooks Brothers. Brooks Brothers is the most iconic American brand, said William Sussman, managing director at Threadstone Advisors. This is a case of a failed company, not a failed brand. The apparel retailer, known for its suits and formal clothes, has been hit especially hard by the health crisis as remote work, job interviews through Zoom, and the postponement of celebrations like weddings, bar mitzvahs, and graduations resulted in sharp sales drops. However, revenues have been flat for a long time. Since 2016, the company was in need of liquidity. At the peak of the pandemic, it filed for Chapter 11 bankruptcy, and in April 2022 it announced the shutdown of 51 stores. Creditors say that number could climb up to 70 locations by the end of the year as the unemployment rate rises. Many of those who do have jobs continue to work from home, and higher inflation means that it's getting increasingly difficult to get Americans to buy nicer clothes, let alone wear them. We're seeing our economic landscape changing, and it is happening fast. The rapid demise of some of the nation's most famous brands is extremely alarming and shows just how vulnerable our economy has become. If you are a loyal customer of one of these brands we've featured today, maybe you should visit their stores while you still can, because soon they may disappear forever. Thank you for watching. Please subscribe, share this video. We look forward to your comments under this video.